Hey everyone, and welcome. Do you ever look at the global markets and just see chaos? Stocks are up one day, down the next, and the reasons seem to change every single time. Well, what if I told you there's an operating manual for all of it? A kind of system schematic that shows how all the pieces are actually connected. That's what we're going to get into today. Intermarket analysis. So here's our game plan. We're going to start by decoding this market machine. Then we'll break it down into its four key parts. After that, we'll look at how those parts all talk to each other, how they behave in four different economic climates, and finally, we're going to build you a personal macro dashboard so you can actually diagnose what's going on yourself. All right, so the big challenge for all of us is trying to find the real signal inside all of that market noise. I mean, one minute a jobs report comes out and stocks just take off. The next day, some inflation number spooks everybody and everything tumbles. The goal here is to stop just reacting to headlines and start understanding the deeper mechanics of the whole global financial system. Have you ever caught yourself asking questions like this? Like, wait, why are stocks falling if bond yields are also falling? It feels totally backward, right? Good news for bonds should be good for stocks, except when it's not. And what's the deal with the US dollar? Why does its strength or weakness seem to send these massive ripple effects across the entire globe? Well, these aren't just random quirks. They're clues. They're symptoms of a system at work. And the key to deciphering those clues is a framework called intramarket analysis. You can think of it like a blueprint. It shows us how currencies, bonds, stocks, and commodities are all linked together in this dynamic cause and effect relationship. Now, this isn't about predicting the future with a crystal ball. It's about understanding the present by, actually reading the map. So to really understand the machine, we have to know its parts. And the good news is the entire global market can pretty much be simplified down to four core asset classes. Each one has a very specific job to do. So let's meet the team. First up, and you could argue it's the most important, are rates. Just think of interest rates as the price of money. They're like the financial system's gravity. They set the discount rate that we use to value literally everything else. When we're watching them, we're usually looking at the 2-year yield to get clues on central bank policy and the 10-year yield for signals about long-term growth and inflation. But let's zoom in on that 10-year yield because it is not just one number. As you can see right here on the chart, it's actually made of two critical components. You've got the real yield, that's the purple line, which is basically the market's bet on real economic growth, and then you have the break-even rate. That's the gap between the two lines on top, and that's the market's forecast for inflation. This distinction is everything because the reason yields are moving tells you what the market is truly worried about. Next up, we have equities, stocks. These are basically a claim on a company's future profits. And their value is in this constant tug of war between two different forces. On one side, you've got fundamentals, how much money the company's actually making. And on the other, you have valuation, which is set by that discount rate we just talked about. So a strong economy can boost earnings, but rising rates can shrink the valuation at the exact same time. Then there's the big one, the US dollar. And it is not just another currency. It's the world's main funding and settlement currency. So here's the key takeaway. A stronger dollar acts like a tightening of global credit. It makes it harder for everyone else to do business. A weaker dollar does the opposite. It's like a global economic lubricant. And finally, we have commodities. This is our direct line to the physical, real economy. But you can't just lump them all together. Oil gives us a read on inflation. Copper, they call it Dr. Copper for a reason, diagnoses industrial demand. And gold often acts as a store of value, kind of a fear gauge. They each tell a different, really important part of the story. Okay, so we've got our four main players. Now for the really cool part. Let's look at the wiring that connects them. How does a shock in one area, say a surprise inflation number, actually ripple through all the others? To really get how this transmission works, we just need to get these three bridge concepts down. We've already met real yields and break-evens. The third one is financial conditions, which is just a handy index that bundles up rates, the dollar, and the stock market into a single number that tells us how easy or tight money is. And markets move based on changes in these conditions. Okay, let's walk through a real-world example, step by step. Imagine an inflation report comes in way hotter than anyone expected. Boom. Step 1, the market immediately prices in a more aggressive central bank. That causes short-term, 2-year yields to jump. This in turn pushes up real yields and strengthens the US dollar. The net result of all that? Financial conditions tighten, and that higher discount rate makes future profits worth less today, which causes stock valuations to fall. You see the chain reaction? It's like dominoes. So we've built the machine, and we've seen how the parts are wired together. Now let's see how this whole system actually operates under the four main economic environments, or regimes, that it cycles through. And listen, this isn't just some abstract theory. Look at this long-term chart. It shows the ratio of commodities to equities against the US dollar. You can clearly see these huge repeating cycles, the tech bubble, the commodities boom, you name it. These are the regimes in action, and they prove that certain environments predictably favor certain assets over long stretches of time. And we can map these environments with a super simple 2x2 grid. All you need to know is the direction of two things: growth and inflation. Is growth strong or weak? And is inflation getting hotter or colder? The answer puts you in one of these four distinct boxes. So, regime number one is Goldilocks. This is when growth is good, but inflation is falling. Not too hot, not too cold. It's pretty much the perfect environment for stocks. Rates and the dollar tend to drift lower, which makes financial conditions easier, and equities just love that. The key thing to watch for here is falling real yields. Then we have the inflation shock, which, well, many of us just lived through. Here, inflation is the #1 problem, and it's forcing central banks to get aggressive. You'll see short-term rates, real yields, and the dollar all shoot higher. This is a classic tightening of financial conditions, and it is generally just brutal for stock valuations. Next up is the tricky one, the growth scare. This is when the economy is weakening and recession fears start to take over. And this is where the old rules seem to break. You'll actually see both rates and stocks fall at the same time. So why does that happen? Because the market's focus has completely changed. It's not worried about inflation anymore. It's terrified that company earnings are about to collapse. It's a classic risk-off environment where investors basically sell everything and run for safety. And finally, we have reflation. This is that optimistic phase, usually right after a recession. Growth is bouncing back from a low point. Now, in this regime, rising rates are actually a good thing. They aren't going up because of inflation fears. They're rising because the economy is getting stronger, which just confirms the recovery is for real. The dollar usually weakens here as global growth picks up, and cyclical assets like industrial commodities and stocks tend to do very, very well. Okay, so we've covered the theory, the components, and the different operating environments. Now, let's put it all together into a practical toolkit, your very own macro dashboard, that you can use to figure out what's happening in real time. And here it is, your macro dashboard. This is the handful of key indicators you really need to watch. The 2-year for policy, the 10-year for growth, its real and break-even parts, the dollar index, key commodities, and finally, credit spreads, which just measure the stress in the corporate bond market. Think of this as your control panel. And to actually interpret what that dashboard is telling you, you just need to ask 3 simple diagnostic questions. First, is the bond market worried more about growth or about inflation? Second, is the dollar moving because of fear or is it moving because of optimism? And third, are commodities falling because of weak demand or because of some separate supply issue? The answers to these questions will tell you exactly which regime you're in. So the next time you see the market making a huge move, you won't just see chaos anymore. You'll have the framework, you'll have the dashboard, and you'll have the right questions to ask. You'll be able to look at the relationships between all these assets and actually diagnose the story the market is telling you. So I'll leave you with this. What will your dashboard